we have a timestamp problem. The Korean market had already taken a massive hit and closed for the day on Monday.
Right. And that was before the report about a new Chinese DUV lithography tool began circulating globally during U.S. business hours. A story published after the first crash cannot explain the whole crash.
So what really broke the chip trade?
Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Let us look at the tape. The broader market was weirdly calm. The Dow closed at 52,747.32, up 1.03%. The S&P 500 hit 7,428.78, up 0.21%. The Nasdaq was down a fraction, 0.22%, and the Russell 2000 was up 0.2%.
And the VIX, the fear gauge, actually closed at 1821. That is down 2.46%. But underneath that calm index level, the internals were violent. The semiconductor index, the SOXX, was down 4.8%.
The SMH was down 3.45%, while IGV software was up 0.96%. Oil was down too, WTI at 79.18, down 4.15%.
The 10-year yield sat at 4.6%, and the dollar was essentially flat. But Nvidia closed up 0.25%. While its entire supply chain was liquidated.
That is the tell. When fear falls during a 4.8% semiconductor drawdown, you are looking at rotation and de-risking, not a broad panic. Broad panic sells everything. This market sold one very crowded chain. If we want to understand that crowded chain, we have to rewind. The KOSPI did not break on Monday. It started breaking 6 weeks ago.
Exactly. The KOSPI started 2026 around 4,310 and peaked on a close basis at 9,115 on June 22nd. That was a 111.5% run. Today, July 28th, it closed at 60's end and 23.66. It was down 10.84% today and is now down 33.9% from the peak.
But context matters. Even after a 33.9% haircut, the index is still 39.8% higher year to date.
Right, but the volatility is staggering. We have seen 14 daily moves of 4% or more since June 15th, including a 9.99% drop on June 23rd. That was a full month before this week's DUV story.
Which points to leverage. Korean margin loan balances hit a record 38.63 trillion won on June 24th, and by July 15th, they were down to 34.37 trillion. That drop is consistent with forced deleveraging, not a market that suddenly discovered one new fact. Today, Samsung was down 13.4% and SK Hynix down 14.7%, triggering a circuit breaker. Let us test the DUV theory. If a domestic Chinese immersion tool is the cause of all this selling, the cross-section of the market should look very specific, right?
It should, but it does not. On Tuesday, ASML closed down 4.37%, but the SOXX was down 4.8%. Applied Materials fell 7.82%, Lam Research was down 7.54%, and UCTT dropped 10.89%. ASML outperformed its U.S. equipment peers, despite taking its biggest China hit on Monday.
Okay, but ASML is the company most directly exposed to a Chinese alternative. Why would it hold up better than the rest of the chain?
That is the inconsistency. Nvidia was up 0.25%, Broadcom was down 0.6%, and Arista was down 0.61%. Even the analog names with high China revenue held up better. Texas Instruments was down only 0.84%, Analog Devices down 1.63%, and NXP down 3.19%. It does not fit a clean, single-cause China supply explanation.
Could the market simply be looking further ahead than current revenue? Maybe they are pricing in a structural shift we have not fully modeled yet.
Yes, which is entirely fair. And that is exactly why we need to do the arithmetic on what this reported tool actually changes.
Let us walk through the numbers on this reported Chinese immersion DUV effort. We are talking about roughly 5 tools in 2026 and about 20 in 2027.
Compare that to ASML planning capacity for around 130 immersion systems in 2026 and 30% more in 2027. And keep in mind, this is reported and officially unconfirmed by any Chinese corporate or government entity. The reporting identifies various entities, but sometimes conflicts.
The capability is reportedly around 28 nanometers for single exposure, and maybe 7 nanometer class via costly multi-patterning. But yield, reliability, throughput, and scaling are all complete unknowns.
The expert reactions reflect that uncertainty. ODDO BHF told CNBC to take it with a pinch of salt because it could be limited to the low end. Semi-analysis noted that scale, fleet performance, and the economics of competing against fully depreciated ASML tools all work against it. Plus, a tool ASML cannot legally or physically supply does not subtract from a sold-out order book.
Bank of America kept its published buy rating and $2,845 target on ASML. Its note called the sell-off an overreaction and estimated that 20 local tools would affect about 2.4% of ASML's 2027 group sales.
It is a real strategic milestone and supply chain insurance, but the near-term arithmetic just does not support a structural collapse.
If DUV is not the whole story, what about CXMT? Their Shanghai IPO was massive. It went up 466% on day one, with a tiny 6.73% float and retail oversubscription over 200 times.
CXMT having about 7.67% of the 2025 global DRAM market and moving toward around 14% by 2027 is a real risk to commodity DDR4, DDR5, and LPDDR margins. It is a much more coherent argument.
But if a near-term supply shock were hitting the market right now, it should show up in prices first. Instead, DRAM contract prices are still rising sharply, with conventional PC DRAM up roughly 100% quarter-on-quarter in current forecasts.
They are roughly 3 years behind on commodity nodes, and their HBM samples remain unqualified externally, while Nvidia already consumes HBM4.
The bottlenecks there are TSV, hybrid bonding, known good die yield, stack height, and customer qualification, not simply lithography.
Right. CXMT is the more coherent China supply argument, but it is a 2027 and 2028 commodity memory risk. It is not evidence that this year's HBM economics broke today.
So, if the evidence does not show near-term economics breaking this week, why was the selling so violent? I keep coming back to how a headline translates into a circuit breaker.
Think of the market like a theater. A real alarm goes off. Maybe it is these China headlines or some financing concerns. In an uncrowded theater, people just walk to the exits.
But this theater is packed with people sitting in borrowed seats, and there is only one narrow door. So the exact same alarm creates a stampede.
Exactly. Korea's record margin debt and concentrated index weights explain the circuit breaker magnitude. But it is not just Korea. U.S. FINRA margin debt hit a record $1.502 trillion in June, up from $1.416 trillion in May.
Which means record leverage does not predict the exact top, but it fundamentally changes the transmission mechanism. Normal selling quickly becomes forced selling. While everyone was watching the stock prices, there was an indicator in the credit markets that almost nobody was watching. Nvidia's CDS.
Credit default swaps. It is essentially an annual insurance premium on a company's debt. Nvidia's 5-year CDS hit a record of about 82 basis points on July 27th. It was roughly 40 in early July, around 68 on Friday, and then jumped another roughly 14 basis points on Monday.
Daniel O'Regan, a managing director of equity trading at Mizuho, had a quote on this. He said, "I never looked at Nvidia CDS before yesterday. Why would I? It's Nvidia, the largest and most profitable company in the world."
But before anyone panics, here's what you need to know. Nvidia's CDS only began active trading in November 2025. It is thin and illiquid because Nvidia historically carried very little debt, and 82 basis points remains firmly investment grade.
So it reflects anxiety about that reported $250 billion OpenAI guarantee and financing structure rather than an imminent default, especially since that reported deal is early stage and Nvidia has not publicly confirmed it. If we want to see where the credit market is actually feeling pressure, it points to Oracle, not a broad AI credit cycle. Oracle's 5-year CDS is trading around 215 basis points, and S&P downgraded it to BBB-minus on July 9th, the lowest investment grade rung.
The drivers in S&P's public reporting are heavy. We're talking about fiscal 2027 capex around $90 to $95 billion. an expected free operating cash flow deficit of about $42 billion, and leverage above 4 times. Roughly half of their $638 billion backlog, about $319 billion, is linked to OpenAI. CoreWeave is also high yield at BA3.
But Moody's notes that Microsoft, Alphabet, Amazon, and Meta retain among the strongest corporate balance sheets, and their investment-grade ratings are not under imminent threat. Across the 6 Moody's tracks, direct debt is about $460 billion, lease commitments about $1.2 trillion.
Their capex forecast is $785 billion in 2026 and near $1 trillion in 2027, which is why broad credit remains remarkably calm. CDX North American investment grade is around 77 basis points, and high yield is around 275 basis points, both historically tight.
This is idiosyncratic financing structure risk, concentrated in specific borrowers, not yet an AI credit cycle.
That is how we would read the dispersion tonight. Broad spreads widening would prove the view wrong, but we are not seeing it yet.
A lot of this gets tested on Wednesday. The FOMC decision is Wednesday, July 29th, and a hold remains the base case around 63 to 66%, with a hike probability roughly 1/3. If September is mentioned, it increasingly prices at least one hike.
Then you have Microsoft and Meta earnings on Wednesday, followed by Amazon and Apple on Thursday. The tells we are watching are hyperscaler capex and free cash flow, DRAM contract pricing, broad credit spreads, and whether semiconductor breadth stabilizes after the Fed.
The most striking image from Monday's fall was Apple reclaiming the most valuable company title around $5 trillion, while Nvidia slipped below it. Apple obviously has major AI investments too, but the contrast is lower visible external AI infrastructure financing.
It perfectly captures the open question of the week. Did the market discover new semiconductor economics, or did it merely reveal who was over-leveraged in a crowded trade? Tomorrow will not settle everything, but it should give us a much cleaner read. Back at it after the prints.
That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.